Welcome to Investors Guide. Thanks for joining us on the show this week. I'm glad you tuned in. We're going to continue figuring out how we can make our investments work in this environment of high interest rates and high inflation. We're going to answer more questions, plan your portfolios and help you with your taxes as well on this show. Remember, you can write to us on the email ID that's flashing at the bottom of your screen. So let's get straight to it. This is what we're going to be doing over the next half hour. We're going to find out if it makes sense for you to break your running fixed deposit and reinvest that money in a new fixed deposit with a higher interest rate. That's coming up later on the show. We also review the Reliance Tax Saver Fund, and we'll answer your questions on saving tax at the end of the show. All of that's coming up later on the show, but first let me introduce Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us on the show. Dhirendra, thank you so much for joining us. We have a lot of questions to ask you, so let's get straight to our first question. Well, Vivek Sharma has written in. He tells us he's 32 years old and he's from Chandigarh and he's invested in mutual funds. He sent us the list: the Birla Sun Life Frontline Equity, HDFC Top 200, HDFC Equity, DSP BlackRock Equity, the IDFC Premier Equity and the Reliance Regular Savings Balance. He says that he's made these investments based on advice he's heard on this show. Now, he also has a couple of insurance plans. He has the LIC Endowment Life Insurance Plan and the Aspire Life from Bharti AXA. Now, he tells us as far as his LIC plan is concerned, he's been paying for the last 7 years, he's been paying premium. And right now, if he were to redeem that money, it wouldn't give him even the amount that he's paid in so far. So he wants to know if that's a good idea. And he also plans to invest in gold, but he doesn't know if he should be using a feeder fund or a gold ETF. He wants to know which would be the best way to go. Now, from his portfolio of his mutual funds that we're looking at, would you say this is the perfect portfolio for a 32-year-old, or would you like him to make some changes?
No, I think if he's little conservative than a 32-year-old, the typical 32-year-old we expect to be, then it is a fine portfolio. This looks like a growth portfolio, and which is okay. And about his insurance, I think he needs a much clearer estimation. That insurance comes first ahead of making investment, and I think he should get a clearer estimation. And broadly, 8 to 10 years of his annual income, and he should get himself a coverage for that amount through a term insurance, and then try and find the best way of liquidating his existing investment accumulated in these endowment plans and other insurance policies. About gold, I really don't have an opinion, and I don't think there's a basis of the opinion. Gold is a very unusual commodity, and it has come in the limelight because it is going up and it has sustained, and I have been consistently proved wrong, so I have given up. But I would suggest that keep your balance. Try and achieve this. Don't tilt your portfolio towards gold, and so 5 to 10% if at all you have it. And if you want to really accumulate your savings, small savings in gold, which at some point you will be able to liquidate and buy gold, then I think a gold ETF is a better way of achieving that.
Good luck with those investments. Thank you for writing into Investors Guide. Let's move on now to our hold or sell segment. Within SK Goel has written in from Ghaziabad. He's 68 years old and he's been investing in mutual funds for the last few years. Now, he tells us he has 15 funds in his portfolio and they're becoming difficult to manage. He wants to reduce that to about 6 funds and he wants your help. He wants to know which of these he should be holding or selling. Now, the first one on his list is the UTI MNC fund. Should he hold on to this one?
Yes, this is an excellent fund. It has proved to be extremely rewarding with great stability. And though it does not have a rating because it's in the equity specialty category, it is a fund which invests only in MNC stock, and this fund looks outstanding and also reasonably diversified.
The next two funds on his list, I want to take them together, the HDFC Balanced and the HDFC Prudence Fund. Now, they're both balanced funds from the same fund house. Would you suggest he consolidate in one fund, because he does want us to help him bring down the number of funds that he's managing right now?
Yeah, I would actually, suggest him that this is not just the right. This is not the right way of evaluating his portfolio. Of course, one can trim down. One can always choose the 6 of the best, 6 of the better funds of his list of 16. But I think critical points to be addressed for somebody of his age is that where is he deriving his income from? He's unlikely to expect this. Is this just a growth portfolio, or he expects periodic income? I think that should drive, and that is where I feel that why hybrid. If this is a growth portfolio, then these two balanced funds should not be there. And if he's trying to build a portfolio with which should provide him stability and some periodic income as well, then might be the whole portfolio should be made up of these funds only.
Okay, the next one on his list is the Birla Sun Life Generation Next Fund. Dhiren, would you suggest he continue investing in this and continue holding this?
Yes, this is an impressive fund of late. It started on a very weak wicket and on a very loose mandate, but it's a constrained portfolio. I would say that despite its good performance, he should consider exiting it for trimming his portfolio.
The Birla Sun Life MNC Fund is the next one on his list. Dhiren, continue investing in this one as well?
The fund's mandate is very similar to UTI MNC. This fund has also done reasonably well, but if one has to choose between UTI MNC and Birla MNC, I would say hold UTI MNC and sell Birla MNC.
Alright, a sectoral fund coming up next, the Reliance Banking Fund. We know that that's a good performer, but does he need a banking fund in this portfolio?
Yes, a banking fund, it's always either a great performer or the worst performer, and that is what the character of any sector fund typically looks like. And because he has some good portfolio, he has a well spread portfolio of some good funds. I think he can do without any of these, the banking funds.
Reliance Equity Opportunities is the next on his list. Is this the kind of fund that he should have in his portfolio?
Yes, this is a diverse fund and it is a well performing fund. So he should hold it and continue investing if he is investing.
The UTI Opportunities also the next fund on his list. Is there an overlap between these two funds, or can he afford to hold both of them?
Not really. They of course opportunity is part of both funds' name, but I don't think there is a complementarity. I would say UTI strategy is UTI Opportunity is a core holding of this portfolio and should be a larger should have a larger allocation.
The IDFC Premier Equity is the next one on his list today. This is obviously a very large portfolio, and there are a lot of very different funds in this portfolio, but is this a fund that you would recommend he continue investing in?
This is the kind of fund where if he has to pick funds for enhancing performance and he's chasing aggressive growth, it's the kind of fund which should be there.
The Franklin India Prima Plus is also on his list. This is another fund that you normally recommend on the show, but would you suggest that he hold it in his portfolio?
Yes, this is a fund which should be held simply because of its diversification and its sustained performance and over market cycles. So, this is the kind of fund which should be, if he is trying to simplify his portfolio, then it should be filled with these kind of funds only.
The DSP BlackRock Balanced Fund is the next one on his list today. We know that this is also a good performance in terms of balanced funds, but would you recommend that he holds this one as well?
No, for the same reason that if this is a growth portfolio, then he should not have this fund in this portfolio. And if he is wanting stability with growth, then he has 4 balanced funds. The HDFC Balanced Fund, HDFC Prudence Fund, DSP BlackRock Balanced Fund, and Birla Sun Life 95. The whole portfolio can be built with these 4 funds or three of these 4 funds.
Last one on his list is the Birla Sun Life Frontline Equity. This is also a fund that we normally recommend on this show. So if he is looking for long-term growth, this is a fund that you would recommend he holds on to?
Yes, it's the kind of fund which he should hold and should continue investing. And maybe after he has scaled down his portfolio, most of the money can be poured into these 5-6 funds.
Mr. Goyal, we hope that helps you consolidate your portfolio. Remember, you can write back to us if you have any more doubts about your investments. Well, Amit Biswas has written in. He sent us a list of funds he's been investing in for the last 15 years. But his big question is this: he wants to know, after the direct tax code comes in next year, should he change from the growth option to the dividend reinvestment option in the years to come? He wants to know which would be the most tax efficient under the direct tax code.
He should just choose for the growth plan, because he's right. The direct tax code has a provision whereby dividend from equity fund will also become taxable at rate of 5%. So the dividend reinvestment will effectively be a growth plan where he is not getting the money, but the money reinvested will be, the 5% of the dividend amount will be deducted and paid by way of dividend distribution tax. So the direct tax code does provide for this dividend distribution tax, which does not exist today, and he will be better off moving his money to the growth plan, because the effect will be the same, the appreciation. And once your money is in the growth plan, if your investments are held for a period of 1 year and above, they will be tax free exactly like now. So it will be wise to moving your money from dividend or dividend investment plan to growth plan, and this is about the right time.
Samit, that's the advice going out to you. Remember, pick the growth option under the DTC. It becomes more tax efficient. It makes sense for you to start moving your money into the growth option right now in preparation for the direct tax code. We're going to slip into a quick break. On the other side, Dhirendra is staying with us. He's going to answer more questions and he's going to review the Reliance Tax Saver Fund. Don't go anywhere.